Okay, welcome. No problem. Okay, guys, let's start. Just a few pointers. One sec. Just I've written down a few pointers. The first pointer is regarding. I just wanted, because remember we did that session on intrinsic value. Okay, in the class. I mean, after the class, which we didn't manage to record. Okay. Just one more point. I have to just want to make sure that you guys understand clearly the time value aspect of it. Okay. If you let's look at the option price thing again, once again, the model. Okay, so what we have to understand about time value, we have to be very clear about time value. So let's say, what kind of option is this? If you look at the call aspect, this call, let me just change this back to 25. Let me change this back to 30. Okay, this call, what kind of call is it? ITM, OTM, or ATM? The call. Can you tell me whether the call is ITM, ATM, or OTM? Yes, Puneet? The call is OTM. What about Aurora? OTM. Why? Yeah, 1 minute, quiet, let him answer. Yeah. Yes, proceed.
Because underlying price is higher than exercise. Underlying price is less than exercise price.
Okay, good. Alright, okay, so this is an OTM call. Okay, so then OTM call, what will be the intrinsic value? What will we say mathematically if we want to keep on saying that the option price consists of intrinsic value plus time value? So how should we write the intrinsic value of the OTM call? No. What should be the value? What value should be ascribed? Because we want to be able to always say that the option price consists of IV plus time value. So we should write it as 0 and
0 intrinsic value.
Yeah, 0 intrinsic value, right? So we should write the intrinsic value. What did I ask? Intrinsic value, right? I asked for intrinsic value. So we should write the intrinsic value of this as 0. Okay, yes. Manotra, are you following?
Yes.
Okay, what are you looking at? You're also looking down. Okay, you can maybe put it on. Maybe you can put it on your desk. Then there is less. It's more stable anyway, right? If it's okay, guys. Okay, are you following so far? So we are looking at an OTM call. Okay, but is the value of the OTM call 0? It's not 0. The fair value of this OTM call is not 0. Okay, there is some value. So then what is the time value of this OTM call? What? 30 days.
Yeah. The days to expiration is the time value.
Days to expiration is not the time value. Time value is a part of the option price. What did we do that day? So I should have recorded that session. Remember, we did this whole set of crude oil options. We looked at, now see, these basic concepts are not clear. One minute. Where are the option trader? Let's launch the option trader and see once again. Maybe we can do this session quickly. Let's wait for it to launch. What is so complicated about this question? No. My question is very simple. We have been discussing this out of the money OTM call. Okay? We are discussing this OTM call, and we observe that the fair value of the OTM call according to the model is not 0. Although the IV is 0. The intrinsic value is 0, but the fair value of the call is not 0. Right? So what do we know? That the option price, okay, in this case, for the purpose of this discussion, we treat the value as equal to the price. We know that the option price is always equal to the intrinsic value plus the time value. Right? So in this case, what is the sound? Now my question is, with this same call that we are discussing, the OTM call, what is the what is the time value of this call? Is my question clear? It's like asking how tall is the Empire State Building. Some figure you will give me in feet. How long is 1 kilometer in terms? How long is 1 mile in terms of kilometers? You will give me a number. So similarly, I'm asking you, what is the question clear? I'm asking you, what is the time value of this OTM call? What is so complicated about it? I'm not asking you what it is being affected by. I'm asking you, what is it? I'm asking you, what is the time value of the call? Just like I'm asking you, how many kilometers make a mile?
The value of the call option.
No. So we said that for the purposes of this discussion, the option, we are assuming that this fair value model, we are assuming that value is equal to price for the purposes of this discussion. Okay? Okay? Only for this discussion. Yes?
Difference between.
Difference in what?
Underlying exercise price.
No, I'm asking about time value. What is so complicated? Time value is 26 cents.
Yes, sir.
Because the price of the option, the fair value of the option, and we are saying that for the purposes of this discussion, we will assume that the fair value of the option is equal to the price. I gave you that additional clue, right? That for the purposes of the discussion, we are going to assume that the fair value is equal to. This is already there in your notes. We had the extensive discussion the other day that you don't go mechanically. In fact, that link I've given you, maybe I should remove that link because that link gives a slightly misleading picture. It's actually not misleading. It's not incorrect because it's given you two different formulae for calls and puts, for intrinsic value of calls and puts. Okay. In the case of calls, it will be. In the case of when there is a positive intrinsic value, that is considering only in the money options, that particular sheet has given you that particular link, that options education website link which I gave you in the notes. That says that for the sake, whenever we are only concerned with in the money options, how to calculate the positive intrinsic value, the non-zero positive intrinsic value of in the money options. It says you go for strike. In the case of calls, it will be is underlying minus strike, and in the case of puts, it will be strike minus underlying. But that's a kind of mechanical way. That's why Chuk was getting confused when he was doing it, okay? Because he had just looked at the formula and he was kind of saying. That's why I told you the conceptual way to understand intrinsic value is that you have to ask yourself whether I can make any non-zero positive profit by exercising this option. This is all written in your notes already, okay? Clearly written in your notes. I don't want to travel up your notes because I'll have to take a long time coming back down again, okay? But if you go back up, it is all written clearly in your notes. All stepwise logic, everything is written in your notes. That first you have to figure out, first you have to see, can I make any money by if I do these steps? If I follow these steps, I will immediately exercise the call. Assume that I own the call or the put, whatever it is. I will immediately exercise it. That will give me a position in the underlying asset, and I will immediately square that position in the market. And these set of steps, is it going to give me any positive profit or not? Non-zero positive profit or not? If it is, then only we generally in layman's terms, we say that this has intrinsic value. Otherwise, we say it's zero. If it is negative, if it's going to lead to a loss, we still write it as zero. Why do we do that? Because we always want to be able to say that the price of an option, I think we looked at the December, this one now has 8 days to expiry. Can we maybe, we get a little bit of that. We looked at some options. We looked at, of course, the thing is that time when we looked at it, oil prices have moved up a little bit. December was 56.30 2-3 days ago when we looked at it, okay? Now, as you can see, because London is open also, and maybe New York is just about coming in, so you can see that the market is much more active. You can see the oil futures market this is West Texas oil, is getting a little more active because normally our classes are a little bit earlier in the day, okay? So let's look at this. Now you can see, why do we want to do that? Because we want to be able to say that, if you go back here, we want to be always able to say, are you following so far? Intrinsic value. Conceptually, that is what, don't memorize the formula. Then you'll get confused. You should memorize the concept. Okay, every concept also requires memorization, but you have to memorize the concept that you have to remember what you have to do. You have to ask yourself, can I make any money if I follow these steps? Assume I own the option, immediately exercise it, get a position in the underlying asset and immediately square the position in the underlying asset at the market. Does this lead to any positive non-zero profit? Okay, if it is, then that's the intrinsic value. Otherwise, the intrinsic value is zero. Even if it's negative, it's a loss, then we write it as 0. Why do we write the negative as 0? Because we always want to be able to say mathematically that the option price is equal to intrinsic value plus time value. So if the option price is 3.5 and the intrinsic value is 3, then 0.5 must be the time value. This is clear? That's why we want to write, that's why this one, for instance, this one, what is the intrinsic value? Actually, if you compute how much loss will you make if you follow those steps, you will exercise it immediately, buy the option at 94 and sell it in the market at 85. You'll buy the, you'll buy not the option, you'll buy the underlying asset at 94 and you'll sell it in the market at 85. So you'll lose $9. So you could say but we are not going to write intrinsic value as -9, because then we can no longer say that the option price is equal to intrinsic value plus time value, because then the option price will have to be negative if we write like that. Are you following? If we write the intrinsic value as -9, then if we want to write that, if we want to maintain that relationship that option price is equal to IV plus time value, then it will be -9 plus 0.26. So it will have a minus figure, but option price can't be negative, right? Okay, are you following? So that's why, because we always want to maintain that relationship that option price is equal to time value plus intrinsic value. Okay, so in this case that we see that the OTM call has an intrinsic value of 0. Okay, and so therefore we recall the formula that option price is equal to intrinsic value plus time value, which means option price, and in this case we have assumed that this fair value model output gives a fair value of 26 cents. So we assume that the fair value is equal to the price. So therefore we assume here that therefore this will be written as price is equal to 26 cents, which is equal to 0 plus 26 cents. Intrinsic value is 0 plus 26 cents of time value. Is this clear? Is everyone following? See, basic stuff. Are you following, Ganatra? Yeah? Yes? So now you know that, okay, so this intrinsic value of this OTM call is 26 cents. Okay? Is this clear? If you assume that the price is equal to the fair value. Okay, so this is one thing I wanted to just mention. Okay, two more things to note. That intrinsic value, let's make notes about this. Yesterday, that day, if you remember, we made some here you see once again, you can see one more time. Let's look at this here, mouse over here. What is the underlying futures contract? These are futures options. The underlying futures contract is the December futures contract for crude oil, which is at say 57. Okay, so when we look at the 59 call, what is the intrinsic value of the 59 call when the underlying asset is at 57? What is the intrinsic value of the 59 call when the underlying is at 57? 0. Okay, but what is the price of the 59 call? If we look at it, say roughly around 36 cents. 36 cents. Okay, time value is 36 cents. Okay, now let's look at the 59 put. What is the intrinsic value of the 59 put? Around $2. Okay, 1.96 or $2, let's say. So let's say let's take $2 or 1.95. So you can see here that the option price, if the spread is a little wide over here. Okay, but if you see here, if you take this, it's $2.35. So that means that 35 cents time value is consistent between the call and the put. Okay, it will not be exactly equal, but it is roughly equal. You can see that. So in the case of the put, you can see $2 of time value, total price of $2.35, and that consists of $2 of time value and 35 cents of $2 of intrinsic value and 35 cents of time value. Can you see that in real life? That option prices are equal to intrinsic value plus time value. Yes, Tarun, what is your question?
So you said that it is roughly 1.96.
Yeah, because it was around this 59 to 57.05. So I said 1.95 instead of 2. Okay, so we can just take it as 2. So is this clear? We saw this the other day also, which we did not record. Yes, everybody is following. Piyush, are you following? So is this clear to everybody? We have seen firsthand that this is happening. Alright, so this is the first point we wanted to note down. Let's make a note in your notes also. time value influences, okay? This I'm not going to write that price is equal to time value, it's already in your notes. Price is equal to time value plus intrinsic value, including in the options education flight. What are the time value influences? Can you tell me two important influences on time value, which means two important drivers of time value? That means if it's directly proportional or inversely proportional.
Option price.
What is one of the, 1 minute? Correct, very good. Okay, so two important drivers of time value. Time value, when we say drivers of time value, essentially what we are saying is, because the time value is being reflected on the model output side. This is the model. The time value is a part of the model output, because the price is the fair value is here we are assuming is equal to price, but don't lose sight of it. In general, don't lose sight of the distinction between fair value and price, okay? Because most of your models are fair value models. All the models you'll be doing are fair value models, most of them, and therefore don't lose sight, because I've seen your seniors, they kind of don't have a sense of price, of market price. They're just saying, I have done a forecast, I have got a figure. So you must have that sense that whatever you're getting out is actually a fair value estimate. It really does not mean much, because most of the time it's subjective, except for the true arbitrage free valuation models, which we haven't yet done. Okay, even this is a highly subjective model. Okay, that's why if you notice I've not listed it under it follows AFV procedures, but it is actually not an arbitrage free valuation model, because this one is a big guess. This is basically just a pie in the sky. Like one private equity guy was giving an interview. He was giving an interview about how valuation is done in private equity. So he said, we take a number and just stick it. This is how we do valuation in private equity. So it's a highly subjective assessment, okay, this option valuation model, because this Vol input is just basically you just estimate. You think that it's going to be 2025, but it could end up being anything. So this is not really an arbitrage free valuation model, okay? But here, so basically this is a model output. The time value is a part of the model output, and therefore it is influenced by various types of model inputs, and two of the most important drivers, two of the most important inputs are, one is time to days to expiration, and the other is the IVOL, okay, which is the Vol input here, okay? So here you can see it firsthand. With 26 cents, I'm going to increase the time, I'm going to increase the maturity to 90 days. See what happens to the option price, call option price. It's gone up. So here we would say that it is directly proportional. Okay, so it is influenced by the option price is or option fair value is a function of, among other things, inter alia, it's a function of the days to maturity, and the sign of the first derivative is positive in the sense that the relationship is directly proportional. If you increase the, we should not make a strong statement like directly proportional, because then it goes into linearity versus non-linearity and all that. But essentially it is, if you increase the input, it will increase the output. Okay, it's not the reverse. Okay, so the sign of the first derivative, that is a more correct statement to make, that the sign of the first partial derivative is positive with respect to days to expiration. If you increase the days to expiration, it will increase the value of the option. Okay, this is one we have seen. The other big driver of Vol of the time value, notice that here there is no IV. This is still an out of the money option. There is no IV, no intrinsic value. Okay, all right. So here we are going to make this bigger. We are going to increase it 3 times. So see what happens to the call option fair value, 1.449. It has increased dramatically. Okay, so the Vol is also another very important factor, and you can see that Vol is actually a bigger driver. The sensitivity is more actually. Okay, because in the case of days to expiration, it's almost directly proportional. Okay, it went up by 3 times. No, it didn't go up by, it went by more than 3. It was 26 cents. It went to about 1.5. Okay, so more than that. But this one has an even bigger impact. Okay, all right. So is this clear? This is a point I want to emphasize. As we can see here clearly, that asking this basic question exposed the fact that most of you are not clear about that. Okay, so now we are clear about it. Okay, so that is our first topic. I'm glad that I covered it because see, basic stuff has to be clear. Basics have to be 100% solid. If your basics are solid, then you can build on it yourself. Otherwise, just keep on building, and young people get very easily swayed by buzzwords, investment banking and this kind of thing. Wow, this must be really great. So, and then you start, but you have to always be careful that your fundamentals must be solid. Okay, all right. Okay, so I'm not writing this also because we have already done the exercise. Okay, time value influences. Or let me write it in a slightly better way. Influences on time value. Okay, all right. Now, second point. Now, please notice that we did a lot of trading system calculations in the IPM course, but in this course also we have done some, like the modeling of the limit price for situations where you are doing active, where the decision problem as to where to exit. Okay, exiting at a profit. Okay, if I am buying dollar Canada here, okay, and I have a stop here maybe, then based on my system calculation there will be some decision to make. If I buy it here and it doesn't go below my stop and starts rising, okay, then at what point do I take profit? That becomes an important decision problem, and that cannot be decided arbitrarily. That should also be decided in a very structured way to be consistent with the other ex-ante system planning that you have done. Okay, remember that we did the exercise. Okay, so you must make sure that you are said for your own knowledge. Okay, and you not find these kind of calculations in any book, but these are very important from a risk management point of view, and also from for the sake of keeping your own trading very consistent, internally consistent. Your trading has to be internally consistent. Okay, so therefore at what point, if it starts rising here 35, 36, 37, at what point do I take profit? Okay, so that has to be decided in a structured way. We have done that modeling that is there, but you must integrate everything. When you revise, make sure that you have the full calculation. Okay, that means you should be very clear about all the aspects: how to model the maximum dollar risk per trade, how to model the position size given the entry exit, dollar risk, this, that, everything. All the trading system calculation should be treated as not like if something has gone before in IPM, so I'm not going to do it anymore. So you should not, and then there's one more module which we have not been able to cover yet, which is to make you calculate what I am calculating for your system returns, your project returns, which is your drawdown calculation. How to, again, and then the other part of that is to do to complete the learning of this. That's why when Gulati was asking for can we download the spreadsheet, I told him I won't let you download it because I want you to do the whole spreadsheet from scratch yourself. So you must then, the other part of the learning is that when you go to your calc file, that's why that you can see it to test your own. You can see it to test your own calculations, to cross-check your own calculations, but you must do all this hard work yourself, writing it down, what is this, then writing the spreadsheet program and testing it. All this stuff you should do yourself to cement your own understanding. So that's basically a two-pronged set of exercises. This actually can be done as a case. One can actually do a case, which I gave you also in the IPM exam. We can expand the number of points to be covered in the case beyond what we covered, because now we covered the limit price modeling also, take profit limit price modeling. Okay, and then an additional, so all of this actually there's two parts to it. One is to understand the concept, for which you don't need a spreadsheet. Spreadsheet just comes later for programming. Okay, this is just a programming environment. You have to look at a spreadsheet as it's a programming environment. That's what it is. Okay, so but for your concept should be clear on paper and pencil itself. You should be able to do the numbers on paper and pencil. Okay, so maybe big calculations with 6 decimal you can't do manually, it will take more time, but the concept should be clear on paper and pencil. First you get all the concepts clear. Okay, what are you doing, how to model, what is system edge, okay, what is the gross profit of the trade. Like here for instance, if you remember, estimated gross profit we are writing, so that we can write gross profit in the same way that when you look at financial statements, they write revenues minus cost of sales, that equals gross profit. So to be consistent with that, I have written gross profit like this, which means all losses, total losses, and total profits. Total profits minus total losses is we have written as gross profit. You could also technically argue this should be called net profit, because this is actually gross profit. This is gross profit, and this is net profit. You could argue this, but the reason I've written it as gross profit is because I want to be consistent with the financial statements. Because all revenues, this is basically like revenues. Returns from all profitable trades is like revenues, and losses on all losing trades is like expenses. So revenues minus cost of sales, sales minus cost of sales is equal to gross profit. So I've written, that's why I've written, so just to, in case you have a question, why didn't you call it net profit? That's a legitimate question, but the reason I've not done it is because I want to be consistent with the financial statement, okay? So all these system calculations, you should be inside, you should be very, very fluent in all this, okay? That system, then this gross profit another way of writing the gross profit, what is another way of, just as a recap, what is another way of writing the gross profit? Is my question clear? What is another way of writing one is of course total profits minus total losses. What is another way of writing the gross profit? System edge and to the number of trades, okay? And you know what the system edge is, the mathematical expectation of the system, okay? So that concept also, these are all concepts. Actually this can be written as a case. And then the last part which we have not covered, so the case for each concept has two parts. First you understand the concept conceptually. You understand the idea conceptually, okay? Like Tarun was able to crack the IPM, one of the few people who cracked that the R3 question, because he understood it conceptually. So that is more important. Just like when I'm telling you intrinsic value, don't memorize the formula, understand it conceptually. How do you arrive at intrinsic value? You ask yourself these basic questions. Exercise the option, get a position in the underlying asset, immediately square it in the market. What is the result? Positive profit or loss or zero? That is what you should remember when you remember. Once you understand it conceptually, you can always do it, okay? So understanding conceptually for every one of these concepts, system edge, everything. One is understanding it conceptually, and then the other part is being able to program it into a spreadsheet. So for your own understanding, you should then create the spreadsheet. That's why I'm not giving you the spreadsheet. You can look at it for your own cross-checking, but you should create your own spreadsheet. That will give you real practice. Yeah. So this is system edge. So another way of writing the gross profit is system edge into number of trades. Yeah.
So we have done a scenario in which we were having risk cap in US dollars, and also in the trading where the term asset was US dollars.
Let's go back now. We have to go back to this, because let me go back to JPY. This is yours, right? This is your notes. Yeah. Okay, so this is also now, and the other thing is, why am I doing this with currency markets? Okay, now we have a whole bunch of asset classes. We could technically be looking at any of these asset classes, but this is very big here, right? So we could be looking at any of the asset classes, but why have I focused on currencies for P&L calculations? For the P&L calculations, that's another aspect of the trading system, understanding the trading system, right? You should be easily able to calculate P&L. Okay, is this clear? Yeah, Gunatra, are you following? Yes. Okay. So the reason I've done it in currencies is because the scenarios in the currency markets are the most complicated. If you can handle the currency markets, you can handle all the other asset classes. Those are much simpler. The currency markets are more complicated. The currency markets give rise to more complicated scenarios. Okay, like when your dollar risk capital is in dollars, but you're trading in sterling yen, then the P&L calculation itself is a little more complicated. So you have to be clear about the formula. That's why I'm doing this. That's why the examples that I've given you are from currencies. So once you do the currency market scenarios, you can handle all the other scenarios. Okay, let's look at it. Yes, going back. So this is where we wrote down the formulae for the different scenarios in the currency markets. You can have three kinds of scenarios. So these are not written in general terms. Okay, I can write it in general terms, but you have to understand it this way, that the way to write it correctly in general terms, because I don't want to be writing in the specific. These are given in specific examples, but they illustrate the general principles. Let me at least call it out while I'm pointing it out here. The first scenario is where your risk capital is in US, in a particular currency, is in dollars, and you're trading in dollar Swiss. So essentially the P&L is not being generated in the currency in which the risk capital is denominated, because it's being generated in Swiss. And remember, because terms asset, always P&L is in terms asset. If you ever forget,
Yes, sir.
just imagine you're sitting in Ghazipur Mandi trading sugar. At the end of the day, your profit is not in sugar, it is in rupees. Okay? So therefore you'll remember that brings you through the inductive principle that basically gives you that idea that P&L is always in the terms asset. Okay? So here what is happening, what scenario 2 that we are looking, scenario 1. Scenario 1 is your risk capital is in, let's say, currency 1, but your P&L is generated in some other currency other than currency 1. Because risk capital is in dollars, but P&L is not being generated in dollars. But the market in which you are trading, the dollar is the base asset.
Yes, sir.
Okay, that is your P&L, your risk capital currency is the base asset. This is one type of scenario. Okay, so that's why you divide the gross P&L by the exit price. Okay, so this is actually exit price on loss actually. So maybe we should write it as, but we know what we are talking about. Basically, we are modeling the loss here. So this is actually the exit price on loss, but it doesn't matter. Let's keep. No, it is not loss. It's actually more general. It has to be kept as a general because we can use this P&L to calculate profit also. Okay. So in the loss case, it will come out as a loss. Okay. So is this clear? Actually, the more general case, if you look at that example of trading sugar in the Ghazipur Mandi, this is your general case. The scenario 2 is your general case, which you can apply in all the other asset classes, in equities, in commodities, when you're trading crude oil, when you're trading, because in most of those cases, it's coming out in the P&L is coming out in dollars. The terms asset is going to be in dollars in most of those cases. There will be some examples because there's a cocoa contract in London which is based in sterling. So you have to be aware of that concept. In that case, you revert to this kind of situation. But this is a more general situation. So the first scenario is in general principles. Risk capital currency, P&L is not coming out in the risk capital currency, but the risk capital currency is the base asset in the market which you are trading. Risk capital currency, dollar is the base asset in the market in which you are trading. So therefore, that's why you divide by the exchange rate, by the exit price. This is the exchange rate. Okay. Second, is this clear? First scenario is clear? Yes, everybody? Piyush, you're clear? Okay. Second scenario is risk capital is in dollars and the trading is all US, Aussie US, which means basically it's a general principle is that the general description is that the P&L is coming out in the risk capital currency. So here this particular adjustment factor does not appear. You just write the P&L as position into exit minus entry. That's why I said this is the base case and these are the variations, right? Okay, so we'll come to your question. I'll just explain it once in general terms. Okay, and then the third scenario is where you have a situation where not only is the P&L not coming out in the risk capital currency, the risk capital is in dollars, the P&L is not coming out in the risk capital currency, and the risk capital currency is not even a part of the market which you are trading. It's not even one of the two assets in the market in which you are trading. Yes, Yash, are you following?
Yes, sir.
Okay. Third scenario, which is different from scenario 2 and 1. Okay. So now you have to divide by, here this I've written is a long sentence, but essentially the concept should be clear, that you have to divide it by the exchange rate between the terms currency. Actually it should be terms asset maybe. Okay, maybe let's write it as terms asset, more general than currency, because the currency is also an asset, but all assets are not currencies, but all currencies are assets. Okay, so I've written it as, we can maybe just to make it clear, we can write both here. Is this clear? The third, so what we have to divide, so in this particular case, when I've got my risk capital in US dollars and I'm trading in Aussie yen, so when I have this particular thing, if I did not put the adjustment, where is the formula for this? Scenario 3, did we write? Yeah, the formula is written. This part is, the divisor is very big. The explanation of the divisor is very big. So the first part of the formula, the numerator is the same on the right hand side, okay, as this, same as this. But what you divide by is not the Aussie yen rate, okay, because that will give you an Aussie amount, okay. You have to divide this by the yen to dollar exchange rate. Okay, in this case you have to take it by the dollar yen rate. You have to divide it by the dollar yen rate. This also you should be clear whether to divide or to multiply. This also you should work through, because that's why all these things, because you're not exposed to it. These are not very complicated ideas, but you're learning them for the first time, and there's a lot of detail. If you miss one step at any point of time, you'll make a mistake. If you remember that day when I was also looking at it, because this is a very funny way of writing equations. We are not accustomed to looking at equations like this. But that day, if you remember, when I was transferring terms, I forgot to take the common divisor. I forgot to take to the other side. So you can make mistakes. Okay. So you have to make sure that at each step what you're doing, you have to be very clear. That's why the concept is more important. First, you have to be conceptually clear. Don't try to memorize the stuff. Then you won't be able to do it in real life. Yes? Are you following? Okay. So now Shochi, what is your question now?
So in scenario 2, we have this for calculating profit and loss, we have this equation.
Yeah.
So if we, for example, if we have this capital in USD and trading in Aussie USD, and we want to take profit at exit or take profit, so what will be the formula for that?
Okay.
Because we don't have the denominator exit price, which we were taking in the LHS. So how we will?
So you will have to now. What will you do? Good question. Good question. Because we did not cover. Because I covered the more complicated scenario earlier.
So what is the question?
Okay. So the question is. Okay. The question is clearly. Let's be clear about the question. What she's asking is, she's basically referring back to that limit price modeling which we did earlier. I think where is that? Here. This is the one.
Yes.
Modeling the limit price for take profit order. Okay, maybe we can put it here a little bit. As a function of position size, entry price, and targeted absolute dollar profit on the trade. We have done this equation, but we have done it for a situation where. Why did I write this as the first? Okay, fine. So the first expression is correct. So this was written as for scenario 1. Okay, this one let us clarify. Example for scenario 1 below. Is this clear? If we write it like this, is this clear? Because here we have the scenarios below. Yeah? Yeah? Okay. Right. So scenario 1 below, we have, I don't know why this X is appearing. Okay. So we write, this is basically written as the scenario 1. So the way you will proceed once again is you have to start from first principles in your scenario 2. Okay. What is your P&L? Now what is your problem first? Your problem is to figure out the exit price. Okay. So remember, this is the P&L formula for both situations where you make a profit or a loss. Okay. So remember, what does this say here? When you're modeling this, you will obviously need these inputs. Okay. You will need to know the position size, you will need to know the entry price, and you will need to know how much profit you need to make. And that also is going to come out of your system calculations, if you remember. So we did some kind of system calculations, like we figured that the return on invested capital required by the investor is 113%. So from there, this means that once you compare this to the invested capital, you get the target dollar return that you need to make. Okay, what is the amount of money you need to make? So you need to make 13% on 5 million. That's your total profit. Yes?
Yes, sir.
You have to make 13% return on total profit. Okay. Well, actually no. In this case, the return is 113%. So you need to make 113% on your invested capital. So your target for the gross profit becomes 113% of 5 million. Right? These are the steps you have to follow. The target for the gross profit becomes, this figure has to be 113% of 5 million. Okay. And then you know that this gross profit can also be written as system edge times number of trades. So the next step is basically you will figure out what the system edge is. Okay. And from the system edge, you will have to figure out what the average win will have to be to produce, because you will have basically, what will you have? You will have system edge into number of trades is equal to gross profit. The gross profit you have already got from the target return on invested capital. Okay. So now you'll put whatever that figure is. Okay. 113 into 5 million. Let's just put it here somewhere, wherever we are going to put it. I don't don't know where, so this is 100 anyway. So that is the system edge. So basically here you'll figure out basically this 113 into 113 into the invested capital. Okay, this is what you need to make. All right. Okay, are you following? 5.625, which is basically, yeah, we have got this also from that only, from that same calculation. Okay, 5.625. So I need to make 5.625. Okay, so now this is equal to system edge times number of trades. Number of trades I already have an assumption. Okay, so from here I can figure out what the system edge needs to be. Now the system edge formula you already know. Okay, then for the system edge, now you have to write this this divided by 180 is your system edge divided by number of trade is your system edge. Okay, this divided by 180 will be your system edge. Yes, because gross profit is equal 1 minute. Gross profit is equal to system edge into number of trades. Therefore system edge is equal to gross profit divided by number of trades. Okay, so you should have the same figure here. We can do it right here. We can do this divided by, then we have this. Yes, correct. System edge is equal to gross profit. Now we know what the system edge is, equal to total gross profit divided by number of trades. Now this system edge, if you write this on the left hand side, okay, and on the right hand side you will have percentage loss into average loss plus percentage win into average win. Out of these inputs or out of the items on the RHS, what is the only one which we don't know? Average win is the one thing we don't know, because we know the number of we know the percentage loss, we know the average loss already from before. We have calculated from the earlier this, from once you have these assumptions and the risk capital, you know the average loss. So we know the average loss, we know the percentage loss. From the percentage loss we know the percentage win. What we don't know is the average win. So now you have to write an expression to calculate, which is also in your notes, maybe in the previous course, but you have to treat it as a continuum, otherwise it will not make sense. So the average win you can figure out from this.
Yes, sir.
What is the average win that is required in order to produce this kind of system edge? Yes, agree Puneet? We can figure it out, because only one unknown is there. We have only one unknown, right? So you can look at your notes, you'll see the formula. We have done all the baby steps. This actually you should be able to do on your own, but it is still done in your notes in baby steps. How to derive the average win, how to write the average win as an expression of, as a function of the average loss, the percentage losers, average loss, percentage losers, and system edge, right? We have started with the system edge and then worked it backwards with the baby steps calculations, and it's all there in your notes. The formula is there in your notes, right? Is this clear? Are you following what is being done, Puneet? Right? Average win is now being figured out as of, because you have everything else except the average win. So now you know the average win. So now you know basically that to prepare to produce this 113% kind of return, all your winners have to produce the average win, and all your losers will lose the average loss. Yes, all your winners must produce the average win, all your losers will produce the average loss. Okay, so now we have the average win. The average win is let's make sure that this has come out of, where has this come out of? This has come out of some arbitrary figure, I guess. I don't think it has come out of this exercise, okay? But you can do that exercise, okay? And figure out what the average win is, okay? So you have that average. Let's assume for the sake of argument that it is 250,000, okay? Now you need to make 250,000. Now let's come back. Is everyone following so far? Aurora, are you with us in the discussion? Okay. Ganotra, you're following? Okay. Your head keeps going down. I don't know why. So okay, so you're coming now, you know this, you need to make that return. So that target PNL that you have, in this case we have taken arbitrarily it as $250,000, okay, $250,000 we have taken it arbitrarily, but in fact you have to find out what the actual number is. So now where are we? Scenario 2. You are going back to scenario 2, right? So Shuchi's question is on scenario 2. So now we are going to write this on this P&L side. We are going to write that $250,000. This is the profit you have to make.
But you said that to arrive at the exit price to take profit, the average win should be 6 times. That is the R3.
No.
Average loss.
Yeah, it is. No. You have to produce the average win.
Yeah.
If you use the R3, then you have to multiply the average loss by the R3. Because your profit target is, so in this case, if we have taken, if assume that the right answer on the average win is 250,000, that is the R3 of 6. Even then, if you take the R3 of 6, what you have to write in this scenario 2 formula on the LHS is 6 times average loss. You have to write it as 6 times average loss, because your goal is to make this profit. Because what is this expression on the RHS telling you? This, whatever your position is, okay, and whatever your entry price is, you are worried about the exit price. This is what you don't know. You don't know the exit price. But what you do know is, whatever is the exit price, it had better give you the target P&L on the winning trade. Because all winning trades have to make the average win. All losing trades will lose the average loss. Right? These are some simplifying assumptions we are making. This helps us to think in deterministic ways. Otherwise, if you do probabilistic modeling with all Monte Carlo simulation and all that, it looks all very fancy, but the point is, it could go wrong. Okay, but here we are doing a slightly, okay, in this particular case is but where we do the maximum loss assumptions, we are taking worst case scenarios, so it can't go worse, it can't get worse than that if our initial assumptions are correct. Okay, so we are leaning towards these deterministic scenarios. So is this clear? So we are making some simplifying assumptions that all winners, and this you can control actually. Okay, to some extent at least, that if it really goes in your favor, you have to make sure that you wait until you get the target profit. Right? You wait until you can make, in this case, if we take 250 is the correct answer, 250K, you wait until you get this much profit. Yes? Alright? Okay, so you have to write, here, is everyone clear on the left hand side? You have to write the target profit, the average win that you have to make. Because now you are talking about at what exit price should I get out in order to meet my profit target. So you have a profit target which is basically driven by your other system parameters and the investor's imposed requirement of return required on ROIC. That is driving. So if to make this kind of ROIC, you can't just arbitrarily get out at any point. You have to get out at a point which is consistent with these calculations. So therefore you have to make an average win on your winning trades, and the average win is $250,000 here in this example which we have taken. So you put the $250,000 on this side. Now this position has already come because the position is already known because you have some, in this case we talked about entering dollar Swiss long at 99.70 and exiting the dollar Swiss as a stop. Okay, we had this exit on loss plan at 99. Right? So when you're talking about a winning trade and how much money to make, if we change this back to dollar Swiss, okay, so we were talking about entering at 99.70 and stopping at 99, okay, wherever here it was, okay. And so this question of now thinking about how much profit to make or what price to exit on a profit, it means that you already entered a position, and according to the strict rules of risk management, if you had entered a position, the size of that position also would have been not arbitrarily determined, but it would have been endogenously determined as a function of entry price, exit price, and maximum risk per trade. Yes? Okay, that is what I've taught you, that you should not determine the position size exogenously, which many even professionals do it, but it's actually not good planning. It should come from the risk planning. Okay, so the position size is already known to you, because why are you talking about taking profit? Because you put on a trade. If you put on a trade, you already had a very methodically determined position size, which was a function of entry, exit, and the maximum dollar risk per trade, which itself came out of the risk capital and the total number of trades, total number of losing trades plus 1, right? The dollar risk per trade, remember? Yes? Okay. All right. So therefore you already have this, you have the position, you already have the entry price because you have entered the trade. Now your only concern is with what is the to be talking strictly in terms of limit orders, talking the technical language of limit orders. What is the trigger price for the limit order, or what is the parameter of the limit order? Remember, limit order has how many parameters? One. If a market order has 0 parameters, the limit order has 1 parameter. So in this case, if we are talking about this dollar Swiss long position, it's a limit sell order. You have a limit sell order, but of course the scenario that Shuchi is discussing now is not dollar Swiss long, it has to be Aussie long. Okay, Aussie long or Euro long, Euro dollar FX long or Kiwi long, all the cases where the dollar is the terms currency, or cable. Okay, remember what is cable?
Sir, in which USD comes in the term. Correct.
Yeah, but what is cable? In the spot foreign exchange markets or in the foreign exchange markets?
GBP upon
GBP, not GBP upon USD, GBP USD, okay, exchange rate where sterling is the base currency, okay, so that is referred to as cable, alright, okay, so is this clear now? So we have this, now the only question is, where was I actually, but anyway, so you have the entry price, and you have to figure out what is the exit price, which has to be done in a way that it has to be done methodically to be consistent with the other parts of the system. So now you will just back this out where we have done this. I think you can do it because it's even simpler than this. It's even simpler than this. It's even simpler than the example we did earlier, right? So this calculation you can do on your own. Yes. Okay. You just have to write it as what? We can just do it here quickly mentally, so at least we know, at least we are doing it. The writing will take a lot of time, but at least we are doing it orally. So PNL is equal to position into exit price minus entry price. This is in brackets, so open this. PNL is equal to position into exit price minus position into entry price. Our goal is to isolate the exit price. Okay, so PNL PNL plus position into entry price, okay, is equal to position into exit price, and then
we need to
divide it by position. Is this clear? Is this correct? Yeah, you can do it either way. So it is very simple to do because there is one term less actually. That 1 by exit price part is not there, right? So you can do this on your own. Okay. So basically now you express the exit price as a function of the other variables. Okay, and that's your exit. That becomes your trigger for the limit. In this case, if you have gone long Aussie, that becomes a trigger for your limit sell order. If that will give you the direct desired average win, and that will be consistent with your trading. So is this clear? So all these calculations, you can see that they are a little bit slippery. So first you have to be very clear about the concepts, okay, and then you need to also practice putting it into the spreadsheet, and then cross check your numbers, right? So that will give you a good test. The only thing we have not done is to take the return stream of your fund. Okay, that when I write this as a proper case, that will include one more element, which is the calculation of drawdown. Okay, remember we talked about drawdown. Drawdown is basically this. If we look at a nice US equity market chart, we can talk about drawdown. See how how strong the market is, because there's a lot of positive sounds coming out on the trade agreements. So the market is quite bullish. You can see how dramatically it's increasing. Okay, right. So now you see, if you see here, drawdown will be basically the maximum peak to trough. If you see this not as the SPY chart, but as your chart of your NAV. Imagine this is the chart of your NAV. You remember NAV? NLV. In the IBTWS, that's being shown as net liquidation value. But the general term that we use in the industry is NAV. NAV consists of realized profits plus unrealized profits. Realized profits can also be written as cash balance. Okay. So if we are doing this, we can write. Maybe I can actually because actually I have reduced that's why we need a slightly bigger zoom, because I have reduced the overall window zoom. Okay, I think we can go back down here. Where are we? 7-Eleven? Today is 7-Eleven? Yeah. all trading system calculations, okay, except for drawdown, which we have not done, okay, which I guess I can write, but we are discussing drawdown, okay, max peak to trough equity. So NAV, in this context we are discussing NAV equal to IBTWS NLV, okay, equal to unrealized PNL. This, remember, this can be negative also. Unrealized PNL could be negative also, okay. Unrealized PNL plus cash balance. Cash balance is also equal to realized PNL, okay, which can also be positive or negative, okay. So this is there, it's all being put down in your own notes file, okay. Realized PNL. So NAV is what NLV, the more general industry term is NAV and net asset value, but IB calls it net liquidation value, okay. So concept is the same, and so that consists of your unrealized PNL plus your cash balance, which is basically reflecting your realized PNL. Is this clear? So yeah.
So I have a question regarding scenario 3.
1 minute. So let's go back to JPY. Good. Yeah. So short trade. So you're talking about modeling scenario of trade PNL for scenario 3.
Yes, sir. I
Yeah.
wanted to know the impact of Aussie on this formula.
The Aussie does not have any impact other than the movement of the Aussie yen. In this case, you're in scenario 3, you're talking about your risk capital being in US dollars and you're trading in Aussie yen. So the risk capital currency is not even a part of the market which you're trading. It's not one of the two assets involved in the market in which you're trading. So the impact of Aussie, if you're talking about impact of Aussie, are you talking about impact of the Aussie US exchange rate?
Yes, so like this rate has not been used in calculating PNL anywhere.
No, it will be. It will be. Basically, what you have to do is you have to estimate here, if you're, especially if you're talking about both cases, exit on loss or exit on. So your question is good. It's a good point because there is a little bit of a gap there. Okay, when you discuss, are we clear what we are discussing now? Third scenario, where you're trading, where your risk capital is in US dollars, but you're trading in Aussie yen. So in general terms, the risk capital currency is not even one of the assets in the market in which you're trading.
Yes.
Okay, because remember, a market is a venue for exchanging one asset against other, exchanging assets. Basically you have two assets in a market. Okay, so therefore here in this particular example, risk capital in dollars and trading in Aussie yen, the divisor here basically is the dollar yen exchange rate. Okay, but conceptually what it needs to be is the dollar yen. You cannot be certain about this rate because it technically, conceptually, to be correct, it needs to be the dollar yen rate at prevailing at the point when the exit occurs, whether on loss or on profit. Okay, so if you go back and let's talk about, let's call this, say, Aussie yen. If we are talking about Aussie yen. Alright, so if I'm going long Aussie here at 75.40, let's say, and I've got a stop, let's say, at 72, okay, roughly. I'm going long at 75.40 and I'm putting a stop at 72. Okay, now what I really have to write in that divisor here, okay, what I need to write in the divisor here is essentially the Aussie, the dollar yen rate that will prevail. I'm talking about the loss calculation now for exit on loss one side, okay, then we'll go to the other side. I'm now talking about the exit on loss side, okay. What this conceptually needs to, you should be clear about what it conceptually is. Just like in the capital asset pricing model, you have to be clear that one of your exogenous variables, that equity risk premium, is God knows whose expectation, but it is a forward-looking variable. It is what the equity risk premium is expected to be for the future horizon for which you are going to discount the cash flows, and that's why you're calculating the cost of equity. It's a forward-looking figure. It's meant to be a forward-looking figure. And what do you normally do? You take some historical data and then you use that as the estimate, which actually conceptually is not very sound. It's like saying that what will be the rainfall tomorrow? Let me just take the average rainfall over the next previous 6 months or whatever, and that really has no, strictly speaking, conceptually is not the correct way. Okay, are you following? So you have to be clear about conceptually what does the model want this variable to be. In this case, this model wants, it's a very good question actually, because it leads us to the discussion of this point, and this actually is a little bit, it's good that you detected it. So this point is a little bit dodgy, so you have to be clear about this. So in fact, what is going to happen is, we cannot estimate this, we cannot actually find out this value correctly, because it's intended to be, is part of the model. When it is written as part of the model, it is intended to be the dollar yen. Your risk capital is in dollars, you're trading in Aussie yen. It is intended to be, I'm going long now at 75.40 and I'm putting a stop at 72. So the divisor here is intended to be the dollar yen rate that will prevail at the time that my stop is triggered, because it's intended to give me the loss in dollar terms, because my risk capital is in dollar terms, my accounting currency is in dollar terms. So it is meant to give me the market value of my loss at the time, and obviously market value of my loss today, it doesn't make sense to talk about it when the market is at 75.40. What is the meaning of my loss? When the loss is realized, I want to know how much is that loss in dollar terms. So it will have to be the dollar yen exchange rate that prevails at the time that your stop is triggered. Now we are talking about the downside only. Now we'll come to the upside. Is this clear? Is everyone following? This teaches you also to think about, when you're doing any kind of model, you have to think about this also. That conceptually, are you following the point that we are making here? That this part is, that's why this question is a very good question, because it forces you to focus on the fact that this scenario 3, there is a little bit of a problem, it's wobbly, because all these cases we are just able to write the same exit price, the previous scenarios, there is no problem. Okay, whatever is the exit price, that will be the figure. Okay, but here there is a problem, because actually it is impossible to know this divisor clearly. Okay, so we have to make a guess, just like in IVOL. When we are doing an option fair value estimate, this is just a pie in the sky number. I might as well go and ask a rickshawala, what, give me a number. You know, it is just a pie in the sky number. It has no real meaning, and it has no particular weight. Okay, so so therefore it's an estimate. Okay, so this is intended to be, so when you are looking at every model that you look at, you must be clear what are the endogenous variables, what are the exogenous variables. Conceptually, what does the model want this to be? Is it a forward looking number like in the capital asset? I'm sure when you did the CAPM, you did not think so deeply about all this, that this is meant to be a forward looking number, and therefore it's conceptually unsatisfactory to just take some historical data, and most of the time I think people just mechanically apply the data. Am I right? You're just taking the data and applying it, right? But you have to think that actually it's conceptually problematic, because the model intends it to be a forward looking estimate, so it's actually impossible to know. Similarly, here you see another example of a model where one of the exogenous variables is impossible to know. It is theoretically impossible to know what it will be. So you must have this consciousness when you're dealing with models, that this is the variable where it is impossible to know theoretically. So you should be aware that whatever you're doing for this is an estimate only. Are you following? So you must have this kind of critical eye when you look at models. Yes? Are you following what I'm trying to teach you to how to think? Yes? Okay. So therefore I do not know what it is. So I'm going to just look at the dollar yen rate today and just make an estimate. Okay, maybe I'll take it a little bit below what it is today, or maybe a little bit above. So I'm just going to use an estimate. Okay, but at least we should be clear about what rate to use. It has to be the dollar yen rate, but also be aware that you cannot know this properly. Okay, similarly on the profit side, wherever I'm going to exit, maybe it tells me that I should exit at 84 if there is a profit. All my calculations to the system tell me that my TP on this trade, entering at 75.40, exiting at 72, the TP should be at 84. Once again, when you come to the calculation of the TP here, okay, you will have to basically, when you're trying to model the exit price in this kind of situation, you will have conceptually it's a little bit unsatisfactory, because this figure will have to be entered as an estimate. This is an estimate. It's not a clear-cut figure like in the other two scenarios. Is this clear? Yeah. So even here, so conceptually, what does the model want this divisor to be? It wants it to be the dollar yen. What is it? Dollar yen rate. The dollar yen exchange rate that will prevail at the time that the Aussie yen goes to 84 and your TP sell limit order is executed. Who knows what the dollar yen is actually going to be? So you are just making an estimate, but you will never know this properly. It's impossible to know. This is also very important because a lot of the problems in finance and economics arise because you'll see, I'll give you some videos from Warren Buffett and actual practitioners like Buffett and Howard Marks and all. They are very skeptical about these models because most of these models have these kinds of conceptual problems. Okay, so therefore you should not be too reliant on it. It's not like a model in like where the pilot is having a coffee and putting the plane on autopilot, because the physics is 100% clear. Physics of flying a plane on autopilot is 100% clear. The only problem is that we can't predict clear air turbulence, which is still a problem. But otherwise it's clear, that's why he can just take it easy. But here it's not that clear, not at all clear, not even remotely clear. So you should have this concept also that these kinds of, there are certain variables which you are using in your model, exogenous variables, which are, it's actually impossible to know. This concept should be there in your mind. You should be able to see clearly that this is a variable which is impossible for me to know theoretically. Okay, that clarity should be there in your head. Okay, so very good question. So that led us to the discussion of this particular problem. So when you are modeling this, in this kind of scenario, when you are modeling the limit exit, the take profit exit price, you will have to make an assumption about what the dollar yen rate will be at that time. Okay, so you have to be conscious that you are making an assumption, and so therefore you will give, maybe in making the assumption itself, you will see that if it is, maybe you can be a little more conservative or whatever like that, you can make some adjustments. Okay, alright, but that's what it is. Okay, alright, so let's go back to, so as I was telling you, Khushbu, this morning, that your batch, the question quality in your batch is so far the best that I've seen of all the batches that I've taught. The problem, of course, is that the questions are still coming for a very narrow part of the population. The questions, I mean, a high percentage of the population should be engaged, but the question quality is actually the best so far I've seen in your batch. Okay, so even I remember in lab also Rajan used to ask a lot of good questions. So your question quality in the batch is very good. Okay, so where are we now? Okay, we have now finished our option discussion. Okay, we are returning to the financial markets module, and we must start this topic, OTC markets versus exchange traded markets. Now unfortunately I'm not satisfied with the material in the book. It's 1.1 and 1.2. okay, but it's not very well written according to me, because we need to first basically, when we are teaching a new concept to the students, we must first make clear the classical distinctions. Okay, clear-cut distinctions must be made before we let me explain what we mean by that. Okay, so I'll go to the chapter 1. Okay, but I will be using my own notes because it will not come out otherwise properly. Okay, yeah.
Understood the topic Vega versus expiration.
You haven't understood the topic. Okay, so Vega versus expiration, we are only talking about one part of that. Okay, which is yours here. Yeah, all we are trying to say in Vega versus expiration is this, that longer dated options, and so this topic comes up partly connected to the idea of the decision problems related to the expiry of the option. When you are going to trade an option, you have decided, you've already made up your mind that I'm going to be, let's say, selling a put or buying a call. These kind of decisions have already been made. You have two more decisions left. What is the strike and what is the expiration? So when it comes to the expiration, the way you decide the expiration is because that's based on theta. Okay, so that's based on theta. I don't know where I put the theta. Maybe I put it somewhere further up. That shows the theta as a function of yeah. So that is that decision is made as a function of theta, but driven by the theta, that if you're going to be a seller of options, you want to be selling short dated options, like this kind of a maturity. Like here you have 8 days. This is a good type of option to sell. Okay, so you sell an 8-day option. Anything below 15 days is good, but I mean roughly, basically we want to be selling options with the short dated maturities. And if we are buying options driven by the same logic basically, because short dated options, the theta becomes very severely negative. We don't want to get caught in that situation when we are long the options, and we want to benefit from it when we are selling the options. So that basically pushes us, when we are buying, to longer dated maturities, and when we are selling, pushes us to short dated maturities. Okay, all right. So what is the other one I was saying? Okay, so that leads us also to a secondary point to consider. Okay, so we know that if we are a buyer of options, we are going to be longer dated. We are going to be in the longer dated maturities. So for that, we just make note of one more relationship, which is the relationship between theta and the relationship between vega and expiration. Okay, so we know that when we are buyers of options, so what we see, first of all, when we note the relationship, we see that I don't know if everybody can see this 9 months. Can you see, Puneet? 9 months, 6 months, 3 months. So what this chart is showing you essentially is that that longer dated options have higher vega. You can test it yourself if you can play around with this. Okay, if you have this is 90 days, you see the vega of this call option is 0.17. okay, if we make this 180 days, what happens to the vega of the option? It increases. Okay, you can play around with this, what you should be doing, so that you get a feel for things. Okay, so you can see that longer dated options have higher vega. And what is vega? Vega is showing you the sensitivity of the option price, okay, to a change in the vol input. Okay, the option price is the model output. Okay, we assume price is equal to fair value. So therefore, if you change one of the model outputs, in this case the vol, what will be the impact on the output? Okay, if you change one of the model inputs, what will be the impact on the output? And that's being given by the vega. So the reason we discussed this very briefly, this important relationship, that longer dated options have higher vega. Okay, that means longer dated options have higher sensitivity to movements in vol. Okay, option prices for longer dated options. So if you decide to buy options, that puts you in the longer dated maturities. Okay, and if you are let's say your view on vol is correct. Okay, because in this case your view has to be bullish because you're buying options. Okay, so if after you go and locate yourself by buying options in longer dated maturities and the I-vol actually moves up, then you get a secondary benefit because the vega of the longer dated option is higher than that of the shorter dated option. So this is a secondary benefit that you get. But it's a double-edged sword. That's why here, what does it say? Double-edged sword. Because if you go long, you're obviously going long because your view on the I-vol is bullish. You're going long options. But if the I-vol view turns out to be wrong, okay, like Tanya was giving us that example where she went and her underlying view was correct, but the I-vol view was wrong. Okay, so if the I-vol view is wrong, then it's a double-edged sword, because then you get hammered much more because you are in the longer dated maturities, because the vega cuts both ways. The vega is not just for when you're making a profit. It just shows you the raw sensitivity of the option price in response to a change in the vol input. Okay, so therefore it will cut both ways. So only if you're lucky and your I-vol view is correct, then you get an extra bang for your buck because you're in the longer dated maturities. Is this clear now? Okay, is everyone clear? Okay, so I was going to start on let's see how much time we have. Garvit is not here today. Oh, we have 7 minutes. We have a lot of time, so we can make a beginning. Okay, you are taking over for Garvit's role. Yash is taking over Garvit's role today. Okay. All right. So let's see now. What have I given you here in terms of reference? We are going into our next topic, which is an important topic because we have not been able to cover many of the very basic topics in finance because we were constrained by having to give you project specific knowledge. But we have covered a lot of material on options. If you can internalize all this, make yourself fluent in it, then you have learned a lot. The only thing you haven't learned is how market makers trade options, but I gave you a flavor of that in response to Saloni's question the other day, towards the end of that video, which gives you the second intuitive meaning of I-vol. That I-vol is the market's forecast of future H-vol. Okay, and that's an important factor for market makers. So you have not been exposed to that perspective. You have been trading options like speculators, like directional speculators. By directional speculators, you have not been trading options like market makers. Market makers trade more on the gamma and the delta and the gamma, okay, deciding not to hedge or deciding to hedge, etc. Okay, depending on, and so their decision making is driven a lot by their future view on what the H-vol is going to turn out to be. And remember, the option market is already giving you an answer there. All these things here, you look at it, 29.79 I-vol. That means basically these options are saying that this is the 8-day options. These are 8-day options, okay? Which means basically what this market is saying is that over the next 8 days, the price movement that will occur, the H-vol calculation if you do and you analyze the vol figure for the next 8 days of movement, taking the data in that figure, that table 15.1 that we took, there were 20 data points. Here there will be only 8 data points. But if you take those 8 data points and you convert it like we converted in that table 15.1 to an annualized figure, that the option market is saying that figure is going to be 29, say 30%. So if the market maker disagrees with this, if he feels that this is too high an estimate, that for the next 8 days the market volatility will not be high enough to record this actual figure at the end of 8 days. The actual H-vol figure, when you look back 8 days at the end of the 8-day period, it will not be 30% if he feels. Then he will say that the option market is overestimating the H-vol that will occur in the future. This is what we discussed. And then he will sell H-vol. Sorry, he will sell I-vol, because he will sell the options because the options are too rich. Okay, so the option price essentially through the I-vol reflects, this is the second intuitive meaning of I-vol, that the option price reflects the market's estimate of the future H-vol. So this is what market makers do. So you should also have some flavor of what the market makers do. Okay, this is what they do. Okay, maybe we can when instead of, I'll just do this one. Yeah. Yeah, it's an I-vol figure. Oh, sorry, I may have said H-vol because I'm going up and down with so many, using the word so many times. So it's an I-vol. This is the I-vol. Yeah. Okay. Right. So maybe what we can do is, maybe I think because you guys have not understood this point very clearly, maybe just to illustrate this point, maybe then I'll cover the exchange traded markets versus OTC markets next time, because we have only 3 minutes left. Okay. So if we look at I don't know if it will actually. This page is not blocked. Okay, you see this I-vol and H-vol chart together. Okay, Microsoft, etc. This actually is they are just plotting it concurrently. Okay, so when the market maker looks at I-vol here is around say 15%. Okay, if we look at this, the I-vol is 15%. Okay, and the current H-vol is, let's say these are 30-day I-vol. The current H-vol is 18%. You can see that here, 18.5%. The current H-vol is around 18.5, and the current I-vol is around 15%. So if the market maker, see the I-vol essentially The second intuitive meaning of eyeball is, again, what this means is that this is saying the option prices. Option prices, essentially the eyeball is the index of the option price, right? That's the first intuitive meaning of eyeball, that the option price market is actually essentially trading in eyeball, okay? Through the option prices, it's trading in eyeball, okay? And so the markets, what is the market's eyeball estimate, which is basically coming out of the market prices? What does it mean? 1%, 15.7, let's say 15%, let's say 15% eyeball for 30-day options right now. What it means is that according to the options market, that if you jump forward 30 days from today, okay, if you jump forward 30 days from today and then look back and calculate the previous 30 days H-vol using the previous 30 days data, which is basically from today, if you were to know what will be the future 30 days price data and calculate the H-vol from that figure will come out to be 15.17. Okay, so when option market makers trade in, basically they take views on delta. They may not hedge their delta exposure. Okay, they may not hedge their gamma exposure. Okay, they may or they may not. They take views on how this is totally driven by how dramatically the price moves. Okay, it is totally driven by how dramatically up and down the price is moving. Okay, so they are going to take and this is also how dramatically the price is moving is also going to affect the H-vol calc. Remember, you saw how the H-vol is calculated. If there is a lot of movement up and down, you could actually end up with very high H-vol figures. So the market maker, essentially what he does, the option market maker looks at the I-vol figures today, okay, and he takes a view on what the H-vol will look like. See, right now the H-vol is 18%. He will either take a view that H-vol is going to be dramatically higher in the next 20-30 days, it will be 25%, or he will take a view that this is going to completely collapse. It will go down to 10%. I'm giving extreme examples. So if he thinks it's going to go down to 10% over the next 30 days, the reading will be 10%. Then this 15% is nothing but the market's estimate of that future H-vol. That's too high an estimate. So the option market is through the option prices, that means the option prices are too rich, they're too expensive, because the I-vol that is coming out of the option prices is giving me a forecast of H-vol which I think is too high. So if the option market is kind of overvaluing the estimated movement, okay, then I will be a seller of options because it's too rich. Okay, I'll be a seller of options, okay, and I will hedge myself accordingly in the underlying market, which is a complicated process. But this is basically what the thinking that market makers go through. And similarly on the other side, okay, that if he feels that it's going to actually be 30% over the next 30 days, then he looks at the option market pricing it as 15%. Then he thinks that options are too cheap relative to what I think actual H-vol is going to be, okay, so then he'll be a buyer of options. This is what market makers do. So that itself, that becomes like another project. How to manage delta and gamma exposure. In this project, you have only looked at Vega. So I'm a little bit 1 minute over. Okay, 1.2 minutes over. No, we have seen that vol charts are actually a little bit mean reverting compared to the spot. Okay, if you look at the optionistics charts, okay, you see long-term vol data. You see that the vol charts are a little bit more mean reverting than the underlying charts. Okay, but in this case, it's not necessarily anything to do with mean reverting. In this case, it's just he's saying that the option prices reflect through the I-vol, they reflect the forecast of the future H-vol. So if the market maker will essentially be trading in the H-vol, he will be experiencing the H-vol through his hedging. Okay, so he will think that he will make a forecast of what the H-vol is going to be, and if his forecast is much lower than the current option prices, he will sell it, because the I-vol embedded in the option price is the forecast for the future H-vol. Okay, so it's as if somebody is saying that, you know, for the next 30, it's just like if somebody is saying in the money markets that average overnight rates for the next 1 month is going to be 15%. If you think that actual overnight rates are not going to be 15%, let's say you're on the money market trading desk, then what you will do is you will lend him money. What did I say, 15%? So think about it this way, if this is what the option market is saying, next 30 days H-vol is going to be 15%, it's just like any guy on the money market desk saying that next 30 days average overnight rate, borrowing rate will be 15%. But if I feel that average overnight borrowing rate will only be 7%, what will I do? I will lend him money for 1 month. So I will say, okay, you borrow money from me at 15% for the next 1 month. And what am I going to do to hedge myself? I will borrow every day on an overnight basis. I have lent him money on a monthly basis, 1 month money. So every day I need to have money to lend to him. Are you following? Because if I'm lending him money, then every day I need to have money to lend to him. I've already lent him for 30 days. But I make a forecast that average overnight rates will be only 7%. So based on, it's a view, of course it could go wrong. But what I'm going to do with this view is, every day I'm going to go into the market and borrow. Let's say I've lent him 100 million. So every day I'll go to the market and borrow 100 million. And if my view is right, my average cost at the end of 1 month will be only 7%. Are you following? This is exactly what the option market maker is doing. That he is looking at the I-Vols that are embedded in the option prices today, and he knows that the I-Vol is a forecast of the future H-Vol, and if he feels, and he takes a view on the H-Vol that is going to happen in the future. And so if the market, the I-Vol is higher than his forecast of future H-Vol, he will be a seller of options. If it is lower than the future H-Vol that he thinks, then he'll be a buyer of options. Just like this money market example. And actually money market traders do this. This is called maturity mismatch, maturity mismatches, okay? So many money market traders will be doing this. They will be lending money if they feel that the 1 month rates are too high compared to the, are you following this? That the same thing, if I lend Yash money for 30 days and every day I go to SG1 and borrow money, I can still satisfy the funds that I have to give to Yash, because every day he's lending me money. But my total cost is the average of all the daily rates, which may be lower or higher than the flat rate that I quoted to Yash. Is this clear? Are you following? Exactly the same concept. And this thing also happens on the money market desk. Okay? Alright. Okay, so we have taken up a lot of your time, but at least you got some more clarity. So tomorrow we must cover the, we must start, and hopefully we can finish this topic. We'll have an extra, because we have a lot of material to cover in the next course also. Okay. Alright. Okay. Yash is not happy with the money I lent him. No. That's why now press only pause, because we see some of the questions that come up. Okay, where is this? Your question is about the book references.
Yes, sir.
So I'm referring to, let's say, when we cover OTC markets as ET markets. So if I have only this 1.1, 1.2, that means you have to read these segments. So you have to go to 1.1 and maybe you should read this. Yeah, 1.1 exchange traded markets, 1.2 over the counter markets.
So this will not be coming in an exam, right? In FDRM exam?
No, if I cover it, whatever I cover in the 20 sessions, then it'll be part of the exam. Depends. Depends on what I cover. If I cover it, then it's part of the exam, it's part of the syllabus. If I don't cover it, then it's not part of the syllabus.
Okay. So till tomorrow, what you have covered will be the part of the syllabus?
Whatever I cover till the end of the course. That's all part of the syllabus. And what other book references are you talking about? Like H-Vol, say in the H-Vol Calc, let's say.
Yes, sir.
In H-Vol Calc, when we are looking at this topic,
Yes, sir.
okay, calculation of historical volatility, that's our topic. So what am I saying here? I'm saying HB section 15.4.
Okay.
This page number may or may not be correct.
Okay.
This editions change, soft copy, hard copy, but this is correct. The section is correct. So you have to find section 15.4.
Okay, sir.
Yeah, this is clear.
Yes.
So these are the book references.
Yes,
Yeah.
Hello.
Okay.
Thank you.
Anything else?
No, sir.
Okay.